Hello, everybody. Welcome to the Build Weekly Roundup for 2025, Week 17. We got a lot in store for you guys today, even though it seems like it's been a little bit of a more calm week compared to the last few weeks that we've had with tariffs on, tariffs off, etc. But um, one thing you'll notice here is Dave is not with us. He's taking a little bit of a breather on vacation, so hopefully he gets to soak up some sun and enjoy that for the week while he's out. On the Seattle side here, we're also getting a little bit of sun, so after the stream today, I think I'm going to be trying to soak up some of that myself.
Oh, it's beautiful outside. Great time if you've never been to the Pacific Northwest. Has the reputation as a rainy, gray, cloudy, just sullen landscape, but it's false advertising. If you get into summer, especially, you can still catch some of the rain in May and June, but once it gets to August, or July and August, it'll be pretty much the best place in the world. I'm talking like when I first visited out here, I think it was 2010. It was late July. You're right next to the water, pine trees, mountains, hiking, all of that. So free advertising here for the Pacific Northwest. It's like outdoors are like air conditioning. You got the fresh, crisp air of the water. It's there's no place better, in my opinion, in during the summer.
Yeah, I try not to leave, even if I have friends doing trips elsewhere. I just tell them I'd rather be here in Seattle for the few months that we get the 75 sunny every single day. So
Yeah. And with a dollar weaker,
yeah,
this is, my opinion, not the time to go take that summer vacation to Europe, Japan, Australia, wherever you want to go. You're going to get a lot more purchasing power for your dollar at this point in the cycle, staying inside of the 50 United States. So if you're looking for somewhere to go for your summer vacation, give us a shout out and let it holler at us if you're up here in the area.
great. Well, with that, I think we didn't specifically have a slide to talk about for the dollar, but when we talk about the dollar weakening compared to other currencies, just really quick, Matt, you threw out there maybe Japan, not the best spot, but as of right now, but since you've been watching markets over the last couple of days, does it seem like that trend's continuing? Is the dollar continuing to weaken against other currencies? Should I be canceling my Europe vacation coming up here in the next few
So
months?
so the dollar, I didn't go over this chart. For first time listeners, we'll talk about a couple key macro charts every week. One of them we'll put up is the dollar. Second one is long-term treasury yields. Would be the most common. We don't have either of those this week, but the dollar right now is trading. It's plummeting would be a better term, but it's plummeted to the bottom of its uh, range, its channel that it's been in, which is upward trending, right? But it's at the weakest portion of the channel. So we're in a kind of a tricky moment. We'd like to see a little bit of a bounce for the dollar here. Um, but just given the backdrop, everything else going on, um, you don't really expect a strengthening in the dollar in the immediate term horizon. So
Got
yeah,
it.
I would just say for your forward trip, maybe for the rest of 2025, wait and see if you're looking to click buy on those airplane tickets and hotel to Europe, Japan, etc. But caveat, you only live once, right? So if you've been saving up for that trip forever, just waiting for that time, well, if the currency is on sale, like dollars, 10% cheaper, roughly than where it was 5 to 6 months ago. So essentially you're paying, that price premium more so on your international travel. So if you have the time horizon to delay those things, delayed gratification, do that. But if it's something you plan for, also, you know, not everybody likes to plan their life around international foreign exchange.
Well, speaking of, not being able to plan so much, I think, one of the thoughts I had as the tariff announcements came out was if I'm flying out to a foreign country, maybe that's the time to do a little bit of your shopping that won't be impacted by some of these tariffs, but it sounds like tariffs have been paused for a bit. They've been on, off, etc. There's been a few more updates in the last couple of days, even today, even on getting close to deals with certain countries, maybe not what we expected. So Matt, I'm going to flip over to the slide here, but I'd love you to talk through this percentage of trace eligible IG bond issues at a 52-week low. How does the tariff pause relate to what we're seeing here on the chart?
Yep. So remember 2 weeks ago, it was the last time Cameron and I were together on the show. We talked about, all right, April 2nd was Liberation Day. And then for the next week, 5 trading sessions, it just, turned into essentially absolute panic and pandemonium. I was in equity markets, but it was also translating into fixed income and credit. So remember what we saw, yields were selling off. And on April 9th, we got the retreat, if you will, from the Donald Trump X account. I don't know if he launched or posted it on his Truth Social first, but it was the walking back of the tariffs from, here's the across the board. He's like, we're going to do, it's 10% across the board and a 90-day delay. And on that show, it would have been April 10th, we did a weekly roundup. We called for, hey, this was actually the bell ringing, right? The boxing match analogy. Round 1, saved by the bell. It's over. It was a violent, tough week for pretty much all financial assets. But that marked the end of it, right? Round 1. And that's really, I was looking for a chart on how do I communicate this. Like when you're actually active in the bond market on the trading platforms with other institutional managers or broker dealers, all of these players who are basically just the liquidity and credit. What was happening was the liquidity was just backing away. And the best metric I can come up with to show you is not yields, because yields just show you the print on the tape where things traded. How do you come up with a metric to summarize when liquidity is retreating, like across the board on the entire fixed income complex?
Depth almost for everything.
Yeah, and so if you're looking at all the investment grade bond issues, and there's something like 10, 13,000, something about like that, of different bonds that go into the Bloomberg U.S. Aggregate Index. And then if you look at other investment grade rated bonds by the big ratings agencies, it'd be even more than that, right? And so the liquidity hits anything and everything that is a bond or QSIP or whatever identifier you want to use to count these things. But what will happen in a state of kind of panic, something's going on big in the liquidity complex, a good metric to look at is the percentage of of the entire universe of investment grade bonds and how many of them are trading at a 52-week low, right? It's a downtrend in price. And you're always going to have some, right? Just idiosyncratic credits, individual companies, can post a 52-week low if their, business prospects or, decisions aren't going the way the market wants them to. So you'll always have some 52-week lows. But when everybody is having a 52-week low, that's a signal of the state of the overall conditions in the entire complex. And so when you look at April 9th, that was the peak. If you look in the cycle, and this chart goes back to 2005 when FINRA started publishing this data on trace eligible bonds. What does trace eligible means? It just means when there's a trade in the dealer oriented bond market, the SEC registered broker dealer is responsible for reporting the price and volume that the trade took place at to this trace reporting data service. I think they have 15 minutes to get their quotes in. And it just depends on the specific classification and categories of bonds. But by and large, you'll know on these bonds, you actually have a blotter publicly of where these bonds trade, because bonds are different in terms of the way they trade than the equity markets, which trade on an exchange, a centralized exchange basis where you got market makers, broker dealers. They're all kind of reporting into this complex, this web of like 14, ish liquidity exchanges, right? And so those trade, in a centralized fashions, and you see the entire order book, or you can see the entire order book, everything that's not in a dark pool, right? You can see price, volume, and the prints as they happen. The bond market is different. It's not an exchange market. It's a dealer-based market. There's no centralized exchange that these bonds trade on. If you're buying a bond, you're trading it with a dealer counterparty. And for a lot of bonds, U.S. Treasuries work this way. They're not actually like centralized into a reported feed of where did price and volume get struck at for a given trade, right? So for FINRA, they launched this Trace initiative. It's been over, 2 decades ago at this point. But for corporate bonds, muni bonds, some other categories of bonds now, you'll see as trades take place, these usually have pretty big size. A typical bond trade is going to be $250,000 or more would be a round lot or a tradable lot. But they're gonna be big players, big balance sheets, either an asset manager, an institution, trading with, typically it'll be a dealer, and the dealer reports where those prices are taking place. Sometimes, like when liquidity backs away, not even all of the bonds, some bonds won't even trade, right, out of those 10,000 plus, because there is no liquidity, right? So you may not even be able to pick up the fact that liquidity was dropping away, because the trades, it's kind of like that diagram of the Royal Air Force in World War II, the planes that come back, right? And it's like, we should reinforce those spots. And then I forget who it was, but the statistician came up with the Bayesian approach. He's like, no. What you actually want to reinforce is the areas you don't see, because those are the critical areas that if the plane gets shot there, it goes down. Kind of similar analogy in bond world. Like, you may not see trades even taking place. Like some bonds, when liquidity backs away, you can't trade them unless the actual price to get a bid would be so low that the other side of the trade doesn't want to execute you, and the trade just doesn't happen. But point is, overall, when you start seeing a high share of the entire investment grade bond universe of outstanding issues start trading at 52-week lows, that's a sign that something like the liquidity conditions are drying up. So my point here, for April 9th, we called this 2 weeks ago on April 10th. We said that was probably the lull. That's the bell for round one. And that's literally what we've seen. So you get a big spike. About 25% of all QSIPs printed a 52-week low on a single day, and then we saw a retreat. And so I'm active on the screen in like the all-to-all trading platforms. We're responding to liquidity requests. We can be a liquidity maker for our accounts. And those days, that week from Liberation Day to it was even into like April, like middle of last week, so which would have been like April 17th. You were seeing some bonds trade at still like fire sale prices, right? But that in the last 3 days, especially this week, like that's all shored up. Yields are coming in, tightening up. You're not seeing bonds just being puked out, on the street. That is very atypical for kind of time periods that are not end of quarter. So my point here, the bond markets, fixed income, credit, ever since that tweet came out on April 9th, we've just continued to firm up. Now, do you expect the choppy sea, like the easing and the choppy waters, to just continue and assume like, hey, sun's out, waters are calm, everything's good again? I don't think that's the case here. I think it's going to be a pause, but we still have, there's a 90-day delay, and we've talked about this, like that time's up right with the 4th of July weekend. So as we start burning off the fuse and come into that date, look for that to be a forcing function for like what's the next chapter or the next round have in store. But for now, conditions in the bond market, yields are coming in. Fire sale pricing isn't really happening anymore. Liquidity coming in. You've had issuers this week like Walmart came like post Q1 earnings are in, and now your issuers are coming back in to tap the capital markets. And this week we saw some names, household names like Walmart, like blue chips like Walmart, State Street, New York Life, Amex, et cetera. So the window is really back open up again. So that's kind of the overall summary that settling down kind of continues. This may go on for weeks, maybe a couple months, but I am by no means operating under the assumption that the broader chapter is over. And if you looked at prior episodes where we see the kind of the spike where everything hits a few 52 or a large proportion of bonds hit a 52-week low all at once. Right now we don't know what's in front of us, but in prior episodes, so you look at those other episodes where we got that red line and when do we cross over? A lot of times it'll be, one spike and come back down. So everything from like post 2008 up until 2022. 2022 is a different version of this. I'll get into that in a second. But what you'd see is just a surge and then it'd come back down, right? That's kind of the episode of how the system can restabilize in a world where, hey, the Fed's willing to come in with QE. We can just, hold rates low, hold rates at zero, or once we got into 2017, 2018, 2019, like we could cut rates, give some easing to the system. Time will tell, like what's in front of us in the next few quarters will tell how much things have changed because, in the 2010s, that may have been a different environment where we get these, fires and they're immediately put out. But, you see that COVID line in 2020, just a immediate spike and then the fire is doused right away. 2022, though, was a different story where we saw rates want to come up across the board secularly. And we just saw, all bonds adjusting to the rising interest rates. And everything was just, there were elevated 52-week lows being hit for several quarters in a row. And it looked totally different than what we were used to from the 2008 to 2020 landscape. So my point there, that was an environment where interest rates wanted to stay high or wanted to be higher and trend up alongside secular inflation, rising costs, et cetera. So I think it's going to be an interesting kind of watch these next few months to see what happens with this specific tariff situation, these negotiations, if they behave more like what it looks like the decade of the 2020s will look like if we take like that little window from 2021 to 2023 as our guide, or if you want to take the variant perception that, hey, this one will be short-lived, kind of a once in a decade moment, or once in a every few years type of moment, trading day we got on April 9th, and things will quickly settle back in. I'd say we're going to find out, right? If I had to lean towards one perspective, I'd say be careful because from my point of view, this looks like a higher inflationary environment. Interest rates want to rise. There's pressure on the currencies, pressure on central banks, pressure on the fiscal situation. So this one's, play it carefully. Don't count on a Fed or a central bank who's always going to be there to give you the put and put the fire out with someone else's balance sheet.
I think it's interesting to dovetail that with a lot of the Trump rhetoric on having Powell try to convince Powell to lower rates, right? So that kind of fits in with what you're explaining here is the secular inflation. If you have rising rates at the same time, you're looking at that 2021 to 23 spike, right? But it sounds like if you can counterbalance that with the right magnitudes between the two different impulses, maybe that's something you can actually maintain or not have seize up liquidity in markets. Do I have that kind of correct?
Yeah. So the reason I think we do eventually, like we're going to get these rate cuts, these next 75 to 100 bips of cuts, they're coming. They have to move them into the future to wait and see how price levels react, how unemployment reacts, and how the financial system stability reacts to this 180. I guess it wasn't a 180 because we'd already started the tariffs, in Trump administration number one. But we need to see how the system is going to react to not a 180, but a stepping on the gas of policy. So
Right.
what you're looking for here from a central banker standpoint is we want to make sure, all right, there is going to be inflationary pressure, like price levels should rise from these from these tariffs. We need to know by how much, and we also need to know what's going to happen on unemployment because anybody who tells you, hey, this is Pollyanna, this is going to be Holly Smoot, Great Depression, etc., or anybody who tells you this is going to be, massively inflationary, hyperinflation, we're going to be Zimbabwe. Someone will be right, right? But at this
Right.
point, like from a market, we don't know which way this is going to break. Like if you think about it, so how strongly is the consumer going to hold up? Which is, really amounts to are the boomer retiree waves going to keep spending, right? Um, and if you're going out and you're buying, like there will be some pullback, right? If some of these products, like if you look at everything the U.S. imports, like the biggest chunk is like consumer electronics. Uh, U.S. doesn't make its own iPads. So you've seen these exemptions given out to specific categories where there's no substitute good available that the U.S. can produce right now. Remember, like 2018 or whatever, there was a big headline push for, hey, Trump tried to get Foxconn to make, Apple products in Wisconsin, and it's just not going to happen. So like Android, iOS devices, all of that, like it's going to be hard for the U.S. to produce those like like we cannot replicate those supply chains very easily. But there are certain products that you can, easily swap out between a Asian produced economic good or a European produced good and an American good. We can think of several HVAC systems, whatever, like laundry machines, dishwashers. And if you're out in the market buying one of those goods where the substitution effect or the substitutability of a good is there for the American production, then what the tariff does is it price is price, right? You're gonna be as a supplier, you are into a market, you're dependent on what the consumer will pay, right, or can pay. And so you're effectively a price taker, right? Like these aren't monopoly goods, they're washing machines, right? Or something like that. And if the consumer now is comparing models and one is a Samsung that's produced in, say, a factory in South Korea or, wherever. I'm just using one example. And there's one American produced model in the factories in California. Well, now the foreign produced is higher price. American produced can have that competition. They could either try to match it or, steal or increase market share with the American consumer. And so the net effect here with the tariffs is that the playing field has been tilted instead of the way the systems worked for 50 plus years, with everything going on, the dollar, offshore dollars, all of that, where the manufacturing base has the corporation or the business running the manufacturing base has all the incentive to shift production offshore now it's the opposite. They tilt it onshore, right? So if you were already producing in America, you're more likely than not going to pick up that new order, which means those cash flows are staying inside of the U.S. economy, its own financial system, which means more employment, more wages. Like, so we just have to wait and see which ones of these effects went out. But it all depends on how does the American consumer hold up? Do they have capacity to spend? So that's what we're really waiting on. Where does the consumer pull back? It's going to impact different sectors kind of uniquely, but this is essentially what the Fed is doing, the wait and see. Like, how does this entire thing net out? But ultimately, like the the interest rates, especially on the front end markets, the futures, they're still telling you more rate cuts are coming on the front end, right? And that's what, we have not hit the bottom of this credit cycles. We've only, if there's a checklist on things you want to see, there's only a couple. So far, hey, you've got the dollar trading at the low end of its range, right, for the post 2008 uptrend. That's about all. Like, you're still waiting for multiple things before you have
Well,
a lot of confidence as a portfolio manager that the short-term credit cycle has troughed.
I was gonna say, like, maybe walk. Do you have that checklist? Can you walk through kind of some of those other items that you might want to see before you're trying to say or thinking maybe we've troughed?
So you're never going to know it explicitly until the unique headline shows up that calls in the fire department to put out the fire. Like, for example, Lehman 2008, right? You're like, oh gosh, they can't let this go any further. Or 2020, like March 2020, when you got the signal, hey, we're going to do 6 trillion in QE, 6 trillion in fiscal, cut rates to zero, go. Like, those headlines are your signal that it's a bottom. Now, there are some cycles where all you have is market signals, like, where is the dollar? Is it bottoming? Whereas, like, for example, 2016, you're looking at oil, right, as the Saudi excess production was trying to work out the shale producers, like, basically wash out the U.S. shale industry from the market, and were somewhat successful in doing so. They at least delayed the rise in U.S. shale production for multiple years, right? So sometimes you're looking at commodity prices, sometimes at the dollar, short-term interest rates, do they bottom on the chart? But you won't know, like, it's very hard sometimes to get that, like, instantaneous reaction. You won't know until multiple months, quarters have passed, versus sometimes if it is such an abrupt stop, throw 9/11 into that set of examples. But there's things you're always looking at, like short-term interest rates, dollar, where do the futures markets show, Fed funds or SOFR futures now? Where's the hedging activity showing, where the market believes the behavior is going to go? But sometimes it's also the headline just makes it so crystal clear. It's like, yep, it's over. That was a bottom. They're not going to let it go any further. When I say they, I mean, like, the Fed, Treasury, et cetera. They're not going to let this credit problem get any worse. So that's kind of what you're looking for. But sometimes it's much more obvious and apparent than others.
Right. I mean, if there's an announcement of some type of major new backstop facility, right? I mean, that's a pretty clear indication that they need to inject liquidity into the market, right? So
Yeah, they're not going to let it get any worse. But that's also not a sufficient condition by itself, because, the BTFP program in March 2023, right? That was a new liquidity facility introduction, but it wasn't the end of it wasn't the bottom of a short-term credit cycle. It wasn't even close. Like, we we kept hiking before that. And like, as that facility was going out, the common consensus was, hey, this is QE again. Like it's over. They're going to cut. It's like, no, it's not. Like, if you looked at the market signals, like they're going to hike next month. So sometimes alone, like a new facility isn't by itself a sufficient condition to mark the bottom of a credit
Right.
cycle.
It's the magnitudes as well. Okay, and so we spoke a little bit about identifying trends, etc., and historical in the history, right, for bonds, etc. I think I want to flip over to a slightly different but related topic here, which is Bitcoin. So, we've seen Bitcoin. You've got these nice technical analysis lines here. I'm gonna let you explain. What are the lines and what are you seeing in this Bitcoin trend chart?
Yep, let's get out the crayons. It's time to do horoscopes for men, also known as some technical analysis. No, the most important variable you can look at, indicator you can look at, is price, right? And your big markets, your macro asset classes, are some of your most reliable indicators for where things are in broader monetary and financial conditions in my framework. So this is the Bitcoin chart. It goes back to 2023 at the left-hand side. So you can see this uptrend. This has been a bull market in the 2 to 3 year time horizon that you're looking at Bitcoin since it bottomed in November 2022 with that FTX collapse. But that was really in the neighborhood of when kind of a lot of asset classes bottomed. But in terms of Bitcoin, our fundamental thesis, you're not going to find too many bond managers who are also secular bulls on Bitcoin, which makes us a little bit unique amongst our peer group, I would say, right, Cameron?
100%. The number of people I've heard that just laugh it away or say, I don't see how it generates yield, right? I mean, clearly have not done
Yep.
enough work on what Bitcoin is.
Yep, do your homework. I got some good book recommendations for these people if you've got a few of them here. But Nick Boccia's Bitcoin Age, Nick Boccia's Layered Money, and Parker Lewis's Gradually Then Suddenly. And we've got a lot of Bitcoin followers in our audience. But if you're new to us and also new to Bitcoin, those are some of our best friends, but also most well-informed capital markets professionals when it comes to understanding the dollar, fixed income, and Bitcoin. They can do it all. Which, if you think about it, like if you're the true sign of a sound intellect and like a sound trader, financial manager, portfolio manager, et cetera, is being able to explain the bull case, the bear case, the pros and cons, the underlying thesis for not just your point of view, but all asset classes. If you can do that, you're dealing with someone whose opinion is worth listening to, and those two friends of ours can definitely do so. So, highly recommend those books if you're looking to get your starting point on get your bearings on what's going on in Bitcoin. If you ever do make that decision that it's time to take this thing seriously, at some point, you'll eventually get there, hopefully. But yeah, so what we've seen in Bitcoin in this week in particular is a breakout of the down channel it's been in for most of 2025, right? So if you recall, Bitcoin went on a strong run on the U.S. election results in November, particularly Trump carrying the White House, but also that alone probably would have been bullish for Bitcoin, but it was the fact that you got a Republican clean sweep, and we've seen all the policy implementation, basically just the road just paved or opened up in front of Bitcoin for further adoption inside of the U.S. financial system and economy, and that's what we're seeing with kind of legislative agenda results like SAB 121 repeal. Now you've got the Genius Act for stablecoin legislation, Strategic Bitcoin Reserve,
Yep.
all of the above. So Bitcoin went on a run starting really Q4. Like you just look at the September line, you can see it. it just had a massive run up in Q4, but all of Q1 was essentially just a retracement into softness as, Trump inaugurated January 20th and, um, you know, hey, why'd the bull market come to an end, right? But this is what you see during overall bull waves. It's not uncommon to see, a quarter of pullback and consolidation on the way to resumption of an overall bullish trend, which Bitcoin has been in going back to that bottoming in November 22, which is also riding a much broader, primary wave of bullish Bitcoin price action since it arrived on the scene in January of 2009. So my point here, what we want to discuss this week's development was you did see a Bitcoin breakout out of that red. You would call this a bear pennant, actually, like attached to the that bullish behavior in Q4 of 2024. So that breakout would be signaling like a continuation of that overall bull wave that Bitcoin kind of was in before that consolidation it went through in Q1. So overall, it looks like strength here. Now that doesn't mean it's just going to go and rip to the massive price targets like next week. But it is a signal of strength. Caveat that with during that last bit of sell-off where it hits a lower low in that first week of April during the Liberation Day kind of window, pulled back below. I think it almost got to like a $70,000 price level. I don't know where the bottoming was, 73, 74
Just above, yeah.
thousand, something like that. So the prior support line for Bitcoin, that green dashed line, you can see it during this overall cycle. It actually broke below that, it was tested like 1, 2, 3, 4, 5 times, it looks like, before it broke through. So the fact that it fell through that upward sloping support line, that's kind of signaling to me that at some point we're going to go back and revisit that chapter boss, and we're going to spend some time below that trend line, or Bitcoin will spend some time below that trend line. I would expect it to, since we did breach it once, right? Now, we immediately ripped back above that trend line. But what I would say is at some point in the future, whether it's Q3, Q4, or 2026, 2027, I would base case say it's probable we spend some time with price back below that trend line. So that's we call it the good news, bad news. That's the bad news. The good news is that breakout looks for real. And Bitcoin looks to have entered a new bullish trend as kind of first responder of, I guess you can call it risk assets, but yeah, equities, your NASDAQ, your Qs, your Max 7. There's also some breakouts going on there as well this week. Like Google just reported strong earnings, was up 6% after market hours. So kind of a sign that the bull wave is kind of expected. If you're weighing the tug of war between the bulls and the bears right here, I'd say this is a nice sign for the bulls this week, specifically on Bitcoin. So yeah, I think we'll leave it there. But any questions, Cameron?
No, I was just going to add the comment of, I also think there was a lot of rhetoric around that same time about, if China, if the U.S., if we're all tariffing each other, if there's a lot of tension in terms of international trade, are there ways to maybe, find a neutral reserve asset, gold being one of those, which we'll get to in a second. So, I also do think that there were some sentiments that I think kind of we're pushing towards Bitcoin adoption in that front too. So there's a little bit of both the broader macro environment that's affecting this. Also, potentially, some people have maybe done some more research and are realizing Bitcoin might contain some features that they want to have if we're truly in this trustless environment across
Yep.
nations.
So keep in mind too, right axis, the y-axis is log scale. So I've driven, see those two thick green lines, the solid green lines. That's the upward channel that Bitcoin is like the price action that's defining its range. So upward sloping, it's in a strong positive trend. You've got the breakout from that wedge, right? So you got a continuation. The bulls are looking for the ceiling, the upper range of that channel. It's drawn linearly, but it's log scale. So the upper end of that channel are very high numbers, and then the lower channel, even if I tell you, hey, I expect at some point we're gonna cross back over that green dotted line and have to spend some time in that range. It's that green shaded range that gets to higher numbers over time,
Yeah,
right?
that's a really important to
So,
call out. Like,
yeah.
this is the lower bound over here on this dark green line. So, yeah,
So it doesn't mean you can just ape into Bitcoin and expect to be a millionaire next week, like something like that if you're just starting out. Um, but it looks like a very like positive price signals for Bitcoin, and then layer that on with some just news like Strategic Bitcoin Reserve, Stablecoin Act, SAB 121 repeal, banks, broker dealers, et cetera, getting involved in this industry, not just in and that's just in the U.S. Like you had Russia announce this week its own kind of sovereign policy where it's going to start its own Bitcoin and crypto exchange. Like no international customers are going to use this, right? Like no U.S. customer, no European customer is going to go buy their Bitcoin from Russia, right? That's specifically for its own citizens. But the signal is there that the sovereign adoption is coming in like massively with this wave. It's just like the setup is there. It's just, do you see it?
it's almost like you pointed out the gold reserves leaving London, moving to New York, moving to Europe, right? It's which nation states are trying to find ways to bring Bitcoin holders within their borders. All right, well, I think
Absolutely.
that's a good spot to then move over to the other, let's call it neutral reserve asset, which is gold. So, you mentioned here, I think I like the call out tweet here, but I'll let you kind of explain what you were thinking here in terms of this resistance signal.
Yep. Not picking any fights here. There's a great podcast on metals and mining called Mining Stock Daily. There's just content every week, great guests, really informative. But it's a it's an example of a kind of a financial podcast, right? It's not financial advice, but it's like one asset class focused, um, and you'll get a good perspective on the sentiment in that asset class. So everybody, if you're bullish on hard commodities, right, um, minerals, et cetera, even before they go into production of like intermediate goods like iron ore turning into steel, something like that. Yeah, I go here for or go to Trevor Hall's podcast, Mining Stock Daily, for um, signal on what the sentiment is for the allocators, producers, and investors who are hyper focused on the metals and mining sector. And in that point of view, the the best money, the only money, the end all be all is gold, right? Um, so you get a good signal. Like it's been a great bull run here. We've been in 18 months. We've been long it. We've made money for our clients, all of that. But it's a good sentiment indicator in my perspective um, when kind of the chatter gets to the point where it's almost like imagine you're in like a basketball game or something like that, and you're like talking to your opponent, and when the scoreboard looks really, really in your favor, um, some players, they'll start chipping, they'll chirp and talk their game um, as they're up big, as they should, right? Then there's that rare, unique player who will chirp, the Draymond Greens of the world, the Anthony Bennett. NBA playoffs is going on right now, so I'll make this analogy. They've been okay so far, some really good games. Some players will just talk, whether they're ahead or behind.
Right.
Um, but in the case where you get up big, you're always going to hear it from all players. That's when you really lay it on your opponent and you try to put them away. But on Sunday night, we started getting like really strong bids. Like we get used to these price levels really quickly, right? 3,500, you're almost normalized to it. And gold has been in one of these runs, and we'll talk about retail adoption, like really starting to pick up, especially in the last couple of weeks. We'll get into some headlines, but the chart started going into that, it's not a linear trend anymore. If you zoom out, it's like whoop going, but banana peel, Eiffel Tower, that type of setup. So on Sunday night, when you get the tweet going out on 33.95 gold, great and all, but then when you specifically start seeing, people who are hardcore focused on gold, chirping away at Bitcoin. That's tweet. Bitcoin does not solve that. That's a dig on the common phrasing you'll see from Bitcoiners. Bitcoin fixes this, right? Bitcoin is, you'll see like fix the money, fix the world. The Bitcoin kind of thesis believes this adoption is taking place because Bitcoin is better money, like on a variety of properties that it uniquely owns the hill on. But kind of right on time, gold keeps running into strength, but at $3,500, you start to like this week. It was Tuesday. That price action was what I'd consider very interesting. So prior levels in gold, 2,500, 3,000, like round numbers. Gold just blasted through. Like there was no resistance. It was straight up Maginot Line. Like, okay, you're defending this. Okay, we're going to go around through it, overpower you. And gold the last 18 months, like, was just taking no prisoners. 3,500, as soon as we saw that on Tuesday, immediately sold, down 2.5%, 3% over the next, 24 hours, the next, two trading sessions, bounce back a bit today. But I think it's going to be interesting to see the further we go on. Was that $3,500 some intermediate resistance that gold will have to overcome? Sometimes with these numbers, $2,000 was a key one. It took multiple kind of runs at price. The bulls had to go at it a few times. It wasn't an easy opponent. It was a much tougher level boss, if you will. You had to go back, practice it. It took you a couple of days, going back to your childhood playing video games here, right, to figure out how to beat the boss. $3,500 may, as time goes on, look more like the boss level at $2,000, where it took several quarters to chew up the selling available at that price to keep that overall bull run moving. But ultimately, like 3,500, yeah, it's going to fall. My opinion here, but it may take a little longer than these other kind of round levels that gold just completely blasted through with minimal resistance. Well, it may break through 3,500 like by the end of next week. I won't be surprised that way. I won't be surprised too if it takes multiple months, quarters here, as gold finally goes through a bit of a consolidation to force the new entrants, the retail monies, in the middle to late innings of a overall cyclical bull wave, have to come in, earn it a little bit. They weren't one of the early ones on the trend. It's going to be much tougher than this cycle, but or at this stage of a cycle. But I think that's something I'm going to watch. In particular, does gold actually have a consolidation in front of it here in this for where it's at in this 2 to 3 year gold bull run? So that's something interesting to me. But the sentiment and just shouting out Bitcoin when there's really no reason to here.
Yeah, this
I
is
spike the
just your
football, you're doing well, but it feels like from my point of view, it lines up. Um, where the bulls are, pushing their hand a little bit, and might be time for a bit of a consolidation here. And my opinion is what I would watch for.
I think it's also interesting to see the comparisons between why gold is a good investment in quotes, or why people are saying it's a good neutral reserve asset. You start going through the list, and the Bitcoiners know this, but a lot of them end up being almost exactly the same as the features that Bitcoiners are pushing for Bitcoin itself, right? So
Yep.
it's interesting when you have somebody saying, "Oh, Bitcoin does not solve this." Well, it seems like it solves similar-ish problems, but I think there's just different opinions on where that is. So, one thing that jumped out to me, we were talking about this yesterday or 2 days ago, I want to say, in the office, but you mentioned the increased interest from retail, and I was looking at the chart myself, and you see it just go absolutely parabolic, and then that's this little bit here that we have on the screen right now from April 20th to 22nd, just skyrocketing up till it hits 3,500. So maybe let's talk about this slide. You mentioned the gold rush from Wall Street to Main Street. We've seen reports of even Costco selling gold bars, right? So you're seeing this increased interest from retail. What's your take on what's happening a little bit? Maybe some assumptions, or I shouldn't say assumptions, maybe some guesses on maybe why we're going to see a little bit of that retreat from 3,500.
Yep. So if you look at the retail investor, right, um, that tariff week was huge. They were not prepared for Liberation Day at all. By and large, just the average guy on the golf course, 401k employee, all of that saving for retirement. They're long equities, which means U.S. equities. There's not much international exposure. And when we say U.S. equities, it means they're index weight, they're passive, so it means they're loaded up on Max
Max
7,
7,
right?
yeah.
And then they're 40% fixed income. It's 100% currency exposure to dollar fixed income, which is an investment grade in particular. So what do they own? They own a third treasuries, a third mortgages, and a third corporates, right? And so everything we saw from Liberation Day was just like that average median, whatever you say, the median American investor just taking it on the chin. Bad, especially, and it wasn't just one tough week. It was that I think it reminded them of 2022,
It's like a
where
consistent grind
same
down, yeah.
the same phenomenon where everything they owned just got punched in the chin, right? And all of the lessons they learned, or all of the kind of the ways everything worked from 2023 and 2024, when we had a rally driven by your semiconductors and AI, carrying your Nasdaq higher, your S&P 500 higher, and by and large, the level of interest rates kind of stabilized in between that 4 to 5% range. There's a lot of volatility, but the trend line kind of flattened out after 2022. Just let go of the rope. But I think that week in April there, that first week was kind of a flashback for people, like returning to that massively stressful experience in 2022. So in my own life, I had multiple people, our neighbors, our friends, former coworkers, my wife's friends, all ask me like, "What am I supposed to do? Um, and you feel for these people because these are complex things we're talking about here with financial asset prices, markets, all of that.
And they're not
And
professional investment
they're
managers,
not,
right? Yeah.
yeah, they have real jobs, right? They have to do something and then get their kids to soccer practice at the end of the day. They can't just
Right.
stare at screens all day. And you feel for them because you're like, okay, well, the actual yeah, the assets that will actually trend in the right direction for them, like timing, entry points matter, right? And they've been told for 20 years, longer actually, that these things don't matter. You just buy, passive beats active, buy and hold, buy at any price, dollar cost out, buy SPY every month, then buy the bonds, and entry points, whatever, irrelevant. It's not true. It's never been true, right? The only reason that worked is when you're riding a massive secular bull wave in financial assets from 1980 to 2020, right? It didn't matter. The entry points
Hard
really
not to
didn't
lose there.
matter,
Yeah.
and yeah, until they do, right? Um, so even if you want to tell them, it's like, yeah, the median American investment portfolio has no gold exposure. Like they just don't own it. If they do own any financial assets outside of their home, cars, etc., probably don't own gold, probably don't own Bitcoin, all these things. And so to actually start having that conversation with them, um, like on April 9th, when the house is literally going through a fire that needs to be put out, it's not the time for them to, it's not the optimal time for them to make that decision. But what you do see is it's actually people usually do make that decision, that important decision, once they have to, once it's a true five-alarm fire. And that's when they rush into the thing that has been working, which is by and large for the last 18 months, the bull market is in gold. Unlike Bitcoin, which they're not familiar with, it's still new. They can't go talk to their dad or someone they trust. Usually I say dad because if you're going to get investment advice, usually the first person you'll go to, hopefully it's your father did a good job at this or has some insights. Um, but he probably isn't sped up on Bitcoin. But what he would know something about is probably gold. Um, and so you can understand gold, coins, metal. We've been mining. We've been using gold as a monetary store of value for thousands of years, right? So people are going to reach out to whatever life raft they see available, and so during that tumultuous week, what do you do when you're selling your Mag Sevens at fire sale prices? Ticking new lower lows, or bonds selling off. What are you going to go into? Something you're looking for the right life raft. You buy gold, right? That's where we see the historic gold rush is underway in the headline from Wall Street to Main Street. It's not quite as crazy as it was. If you remember 2010, 2011, where you had like 1-800 cash for gold commercials during the Super Bowl, MC Hammer showing up with gold paint, like just the gold euphoria was like all time crazy in 2010 and 2011. We haven't even gotten there yet, and this is at a $3,500 price point, which says like, okay, there's probably higher to go in the future. But for the immediate term, this is the point when our retail jumps in, price starts to go not linear but exponential. You can't a bull market, no matter how strong it is, like you can't support that in the like short run on a day-to-day basis, and that's when you just okay, some selling has to come in to recalibrate the market.
That makes sense.
So I think,
Oh yeah, sorry.
yeah, go
Continue.
ahead. No, go ahead.
I was just saying, so that explains for me kind of you see that top tick. It's really in my mind. I agree with you. It's a lot of retail coming in, even in my own life, anecdotally, right? I have friends who came out and said, "Oh, I just sold off a bunch of my tech shares to go buy gold because look at how great it's doing, right? I'm
Exactly.
saving myself from this massive down coming into that." And so let's flip over now to the more professional side, right? The professional
Yeah.
money managers. You see these. I'm going to put it up here. You see these polls come across your desk. So maybe explain what the sentiment was throughout this set
Yeah.
of polls.
So we're we have a counterparty relationship with Goldman. Trade a lot of bonds with them, and they're a primary dealer, right? They're a broker dealer. That's the nature of their business. And when you're in that centralized role, you actually have relationships with a lot of asset managers, pensions, institutional investors, and you can see their trading behavior, which is like an insanely valuable spot to sit in. Like it can't be like overstressed how much Goldman knows about where markets are, right? That just with the information that they have that no one else can possibly have, just for the role they play in making markets. Um, but they run a survey, like as gold was hitting that $3,500 level, they sent out a flash survey to institutional investors, which they do from time to time, which I thought was like very interesting timing. Not just do they know all the buys and sells, they're not primarily big in the bullion market, right? Um, it's more scattered. Like the financial assets, treasury, stocks, et cetera, like that's Goldman's bread and butter. So when you see like, all right, where is the spot gold market? They want to get more information. So what you do, you send out a survey. And this closed earlier today. It was 977 votes, so you got a significant sample size. They asked a couple of questions that I think are very helpful for understanding where the institutional investor is in this market. So when you line up, where is the institutional investor on price? You ask them, where do you see gold at the end of 2025, right? Two answers: bullish, slightly bullish, neutral, right? I'll put those as bulls, right? I'll call those, bulls. That lines up to 80% cumulatively, see gold closing at 3,200 or above by end of year. And then there's slightly bearish or bearish. There's 14% of the market that are bears, and then I'll give no view. I'll even count them as bears because they're not in the sidelines. So the amount of players who can become bulls and enter the trade, go long, right, is ultimately what bulls means. You've got exactly 20% who can become bulls, so call them bears, and you've got 80% who are in the trade, right? On from a price standpoint, this is their view. So 4-1, bulls are outnumbering the bears on gold, just in terms of price. So that's the way the boat is tilted. So the institutional investor, as opposed to retail, who is like, all right, if you did no view on retail, like it'd probably be like a very high number who are just like, gold, why do I need to own gold? 30%, roughly of Americans, when surveyed, think that their dollars, their Federal Reserve notes or bank deposits, et cetera, are actually backed by gold. So it tells you like the actual the level of information in the broader public when it comes to gold is actually like very low. So the bulls to bears would be like even like a lower ratio on the retail number or retail investing public, which kind of lines up with like where the markets are in terms of cycles. Late in a price run is when the uninformed investors come in, which typically correlates very strongly with retail, right? So what this is telling you, if you just measure the temperature of this wave right now, the institutional investor is still leans very bullish, which I would also align with too. Like you hope for a pullback, even if you're a bull. You want lower prices to keep accumulating. If you're like a truly strong conviction bull on an asset. I would say I line up. I put neutral there. You can see where my vote lined up in that yellow circle. So fully transparent here. But I think that $3,500 still is the level what you're looking at to see like, all right, is this price move actually going higher from here on a short timeline? So that's where sentiment lines up from the institutional investment manager. Now, to bookmark this on where were we in the second, third inning, fourth inning of this run? Where was the institutional manager back then? You can go in my tweets and look at like they have a monthly market poll that does the same thing. It's just more of a standard monthly cadence, and this was a flash poll they sent out ad hoc, just given the unique situation gold was in. It's more of a rare thing for them to do. But we can go back to throughout 2024, especially the first half, 2023. They asked for these same questions, similar on where are you on gold? Are you bullish, bearish, etc. And it like nobody was in the trade. Very little bullishness. Like you were in a minority being a bull then. And this is just how market cycles work. By the time you get to the end of it, everybody's going to line up into the bullish camp. What happens? Price gets pushed to where it really can't go any higher. There's no one left to pull in onto the dance floor who's on the sidelines. There's still people in. It's 4-1, right? There's still 20% who you can pull in, but they're going to be the hardest ones to give in and get to capitulate. But as soon as they do, that's where you're looking for top of a longer time frame cycle. But that's where they are in price. And then if you look at positioning, the next slide, Cameron.
Yeah, I was going to say, I think it's interesting the dichotomy on the no views here between the
Yeah,
previous line.
exactly. So there's 80% bullish, right? But a lot of them, and this could be because a lot of portfolio managers surveyed here, like they may have a specific swim lane where they're like, we're just an equity fund manager or we're a fixed income fund manager. So a lot of these institutional investors they label themselves on positioning as no view. Part of that could be because they can't get in on their institutional account or portfolio.
Yeah.
So they're and getting those things changed is actually much more long term, right? If it's a separately managed account and it's just one asset class focused, and let's say you're PIMCO and you want to do a gold account, like let's say one of their pension accounts says, hey, we want to invest in gold. Well, if you're PIMCO, like that's not your store. I'm sorry to single out one asset manager here, but if you're a bond focused asset manager,
you can't.
You don't have that in your docket or your inventory as a service to offer to clients, right? So sometimes you might tell them, hey, okay, if you're a financial advisor, okay, we can put an investment allocation in gold. We'll add the GLD ETF. That'll work for my existing system, setup, custodial relationship, all of that. So you can get into the trade. You can move into those buckets of currently long, which is 17 plus 27 plus 11. So you're at what? 65%? Yeah. 65% are long. Where are those other, the bulls are at 80, there's 15. Part of those might be to actually get your accounts into the trade, you have to do some work, right? It could be updating an investment policy statement or other guiding docs, or it could be we don't know, like we're not built to deploy and get our clients or accounts or funds deployed into gold. So we have longer term work to do, to do some paperwork, find the right custody arrangements, et cetera. So that's long term bullish, like there's still more to come in. But there may be more operational headwinds to getting that next 15 longs into the trade. Now the shorts, there's nobody here short. Like there's 4%, 4 out of 100. So the bears, right? We said 4-1. Like the actual amount that are short, like nobody is putting a short on, which is like during a bull market, 18 months. If there hasn't been any meaningful correction or retracement, it is very risky to put the short on, right? Because for 18 months, going on 2 years, like however long it's been, if you've tried shorting gold, like you just get run over. Like you just that capital's gone. It's steamrolled. It's just been bid up with very minor retracements. So you can't short it. Like an actual bear who is like, I want to sell gold at 2,500. It's overpriced. I want to sell it at 3,000. Like you're just bleeding money. You can't do it. So at top of cycle, like the first pullback of a broader consolidation, you usually don't expect to see much short interest at all. It's the next leg potentially. Um, the leg after the first, like you think about it, like in Q1, what we saw in equities. First was DeepSeek, semis sold off. The bid came in, firmed up a bit. But then when the real action hit, the shorts piled on in Liberation Day and caused some real technical damage. So it's if you're a bear on an asset, right? It's much safer for you to come in and express that short once you've got an indication that like with the DeepSeek situation, like offering a favorable setup, just in hindsight, how this would work. We saw the semiconductors, NVIDIA, TSMC, et cetera, sell off it was mid-February, I think it was, when we got that DeepSeek release. And that was your sign, if you were looking to short, that the bid below those secular kind of banner carriers over the last 24-month bull wave and the Qs and the Mag 7, the fact that the bid was really soft, had trouble firming up. We saw like a 10% drawdown in Nvidia on that. Or look at the VanEck SMH semiconductor ETF, like good example. The bid was extremely soft. That told you like, all right, once the retail dip buyers came in, but then once we got into Liberation Day and it was time for another down move, they had the inkling, they had the evidence that bid below that those the Mag 7 trade was extremely soft. The wood was wet. You could poke through it with your finger, that type of thing, and they short it. But the point is, you don't short something into a top, especially on the momentum and strength that something like gold has had. Even if you do think price is getting late in the tooth for the overall cycle, it's risky to come in and just short it on that first move down. What you're watching for is some weakness, and then a second move after that. Now with gold, different. Like gold is not the same as the Mag 7 trade at all. Central banks are accumulating, they're buying, and with the credit bubble hitting pretty much every developed market currency, we've got too much debt, not enough economic activity that's coming out of where that debt was allocated into. And so what you have to do to keep the debt, like the bad debts, from washing out in the system is you reprice it in terms of gold, because these currencies aren't, pegged to anything. What they can do, like you have the solution, you just mark them up versus gold. So I don't think you're going to see a situation, what happened to the Mag 7s. I'm not saying that at all. That's not what I'd expect for how gold plays out from here in the coming months and quarters. But if you're a short, there are some bears, and also same way we said about 15% out of the 80 in the bearish camp or in the bullish camp, sorry, are still on the sidelines. Way to get it. That might be a buyer further on from now. But on the bearish side, if you look at it, if there were 4-to-1, there were 20% bears, only 4% of them have even gotten short, right? So this tells you the speculators at some point there's going to be interest coming in to try to sell some gold here, which is a dangerous thing to do. But this is how price discovery takes place. When I say it's a dangerous thing to do, right? It's dangerous to short something that is in a broad underlying kind of secular bullish primary trend, right? Which I'd put Bitcoin, in my opinion, is in one of those. Gold is in one of those. You can do well shorting Bitcoin on short time scales if you time it right. But if you're just always trying to be short Bitcoin, like you're just going to get bled out. Like you're going to lose your capital. Well-timed shorts, you've seen people do extremely well in that. Um, but gold, same thing. Gold's been in a massive secular bull market since 2001. So to try to short it, yes, you can have a good year or a good quarter if you time your short well. But overall, if you're always short, if you're a perma bear on gold, like it's just been not a good recipe for capital appreciation over the last 20 years. Um, but yeah, right now, short interest from an institutional perspective is extremely low. Look for them, like if they want to get short, they're looking for windows of opportunity. And what we're showing is there's more troops on the sidelines to come in on the bear side as well. So interesting price action for gold, just given the momentum, the heater it's been on for 18 months, 24 months. Um, Honestly, even if you're a long-term bull, you kind of want to see a consolidation to give your underlying price move more strength,
Moving
get
forward.
more of the asset into long-term convicted hands, so price can go ultimately higher over the long term.
Great. Well, I think that to me helps me also for my own personal account understand kind of a lot more on where gold is, maybe how I'm thinking about positioning for my own account. So, any last thoughts for this week, Matt, before we let everybody go?
Oh man, we're about to close out another month. It's first month of a quarter, so not that big. But what are we watching next week? We've got a new 2-year auction. Don't expect any problems there. And then new NFP report will be coming out next Friday. And this will be it'll be the April jobs number, which is a lot of it is just a model estimate. The revisions will be what's really important over coming months. But we're going to finally start to see some real economic data prints on the impact of the tariff policies. And remember when we said the Fed, like, yes, my belief is more rate cuts are coming, but if you're the Fed, you want to give it time to see how your key objective, your KPIs are moving, inflation, unemployment, and then your unspoken mandate, financial system stability, how those things develop. So next Friday, May 2nd, we'll get our first indicator on how things are holding up. Now, you'll see some like Twitter threads, kind of the Pollyanna, like, oh, port activity at Port of Los Angeles, San Francisco, New York, like those, like shipping container activity is drying up to essentially nil. Long distance trucking drying up. Like we've just got to wait and see which way this thing breaks on the overall terms. But we'll get the first sweeps on that. I'd say from my point of view, starting next Friday on how the broader economy and the American consumer and labor market are holding up in the face of some really big policy shifts or accelerations, if you will, since we've been on the tariff trend. We've been on that tariff trend since what do they call it, phase one with Lighthizer back in 2017, 2018.
Makes sense. Well, yeah, I think let's watch those indicators next week, and hopefully, depending on how those go, we may consider doing an emergency podcast. But if not, we'll see you all next week, and then the week after that.
All right, cheers.